Hey, hi Pooja, hi Hemant.
Hello, sir. Good morning.
Good morning. So just let's wait for another minute. If anybody else wants to join. Okay, let's just start the session for today. Uh, all right. Okay. So in the previous session for the pre-CMA and FMAA, we discussed regarding the variances. We had a question which we solved. I posted that question in that pre-CMA group as well. So after that, the main kind of concern in a variance analysis is that you make a budget, you have the actual figures, then you do a variance analysis, wherein that variance analysis is going to help you to understand as to why there was a difference, whether the difference was excess, It was a more difference or a favorable situation for you, or it was kind of a adverse situation for you. There could be a chance that the variance would be zero, wherein you estimated something and it turned out to be the same. But in every case, you have to make sure that you go and analyze the things, so that you need to understand as to why the things are happening the way they are. So we had material variances, then we had labor variances, then we had the overhead variances, and then there was something called as sales variances. The one thing which is important to note here is that once the price variance is separated, all other things are to be multiplied by the standard price. So once you separate the price variance, that is standard price minus actual price, all the other variances would be multiplied by your standard price. The multiplier would always be the standard price. In case of labor, it would be standard rate, and so on. There was one more important thing which you need to remember, is that whenever there is an overhead comparison and whenever you want overhead hours, or like hours are required, it would always be the same for the product. So the same hours which are being used for the labor can be used for variable overheads or fixed overheads as well. If nothing is given in requires 5 hours, so this ratio would always be the same, and it doesn't matter where you're whether you're calculating a labor variance or where you're calculating the variable overhead variance or fixed overhead variance. Usually what they do is, for labor and fixed overheads, they have a specific ratio which would be given to you in the question, and there is a separate kind of an analysis which is there for the fixed overheads. So for labor part, what they do is they don't give you what are the labor hours for variable overhead. So this won't be given to you in the question. Only the labor hours would be given to you to calculate the labor variances. But because you know that the ratio is always the same, you can use this equation to calculate your variable overhead hours as well. Then another thing which you need to keep in mind is that whatever formulas we have studied, it's always standard first and actual later. That's why something which is positive uh, will be kind of a favorable thing. Something which is negative would end up having a kind of a negative impact. So positive is favorable, negative is adverse. But then, is it the thumb rule? No. The once the formula changes, the equation would also change. So it is very important that you try to interpret the things. Don't just try to remember the results based upon the sign. So that was one thing. These things will get reversed. Actual will come first, and standard will become would be at the later point for the sales variances, because uh, if our sales is 5,000 and our standard sales expected was 4,000, positive should be favorable. That is 1,000 excess sales we have done. So it is a good sign. But then we still have to make sure that we keep on analyzing this uh, further. Why this was favorable? You still have to analyze it. Just because it is favorable, that doesn't mean that you are not going to analyze it. So this was kind of the things which we discussed. Then we started this CVP analysis, which is cost, volume, and profit analysis. So it was CVP. So cost, volume, and profit. It is one of the important kind of the chapters. This would have a question in your exams, because this is kind of the core competency for a certified management accountant. We don't know what happens in the financials. We are not concerned what happens in the financial when we are studying CVP. So CVP means cost, volume, and profit. What if the cost increases or decreases? What is the impact on volume and profit? What if the volume changes? What is the impact on cost and profit? And what if the profit, what if we want a certain profit, or we want to reduce our profit, we want to increase our profit, depending upon the situation? How do we control the cost and the volume? So that is something which CVP analysis is going to tell us. So the question is now, for CVP analysis, we don't require the standard statement which we prepare for financial analysis. The statement which we require is called as contribution margin statement. So once you have a contribution margin statement with you, you can start doing your analysis for CVP. So how does this contribution margin work? So before understanding how the contribution margin work, we discussed that there are few assumptions in this contribution margin statement. So the first assumption was all the costs are either fixed cost or variable cost. So there is no semi-fixed cost. There is nothing called as semi-fixed cost when it comes to contribution margin statement. When you make the statement, do we have something called as semi-variable cost? Yes, we have. Do we have calculations to bifurcate that? Yes, we have that. But when you're calculating a contribution margin statement, we are not concerned whether the cost is semi-variable or variable, because even if your question tells you that, say for example, the rent cost uh, until 500 square feet would be fixed, and then for every 100 square feet it increases. So after 500, for every 100 it is going to increase at, say, increase at, for example, $100. So because you have an equation in place, it is important for you to segregate the total cost into fixed and variable. So you cannot keep the cost into a semi variable element. Every semi variable cost has to be segregated either into fixed or variable, or partially segregated. So let's say that the cost given in the question or given to you is, say for example, 10,000, and this is kind of an equation you have. So what you will have to do is you will have to make sure that this cost is segregated into fixed and variable. So you have to make sure that you distribute the cost. So there is an equation to do it. So we'll study that in the later section. So there would be an equation which you need to create, that how this semi-variable cost works, and based on this semi-variable proportion, you can always calculate your individual costs. So you're not going to just use this 1000 in your question, but you're going to use the breakup of it. Ultimately 10,000 is going to go in your statement, but it would be segregated into fixed and variable. So that is one kind of an important assumption you need to understand. Then there was one equation which says fixed cost, the total cost is equal to the fixed cost plus the variable cost multiplied by the cost per unit. So this is your total cost equation, which you again have to remember. So how do you calculate your total cost? Let's say your fixed cost is 1000, and your variable cost per unit is 5 per unit, and the number of units which you have produced are, say, 1200. These are the units. So how do you calculate the total cost? So this is your fixed cost, this is your per unit cost, and these are your units. So if you want to calculate the total cost now, it would be fixed cost, which is 1000, plus the variable cost. So this would be the units, sorry. and this would be the variable cost. Yeah. The units which are 1200, and then you multiply it by the cost per unit. So your total cost would now become 1000 plus 1200 multiplied by 5, and that comes to 7000. The third assumption which we had is that the production is always equal to sales. So whatever you produce, you sell it. So if you have produced 1200 units, you're selling the whole units. In practical life, this assumption is not accurate. Almost 99.99% of the times, this assumption is basically a failure, because in not even in a single company it is happening this way, where whatever you produce is getting sold. So there is a closing stock. There is a chance that you produce less, the demand is more, you produce more, the demand is less. So it is always changing. But then if production is not equal to sales, then what you need to do is you need to apply the theory of constraint, sorry. So when your production is not equal to sales, you need to prioritize the things. So let's say, for example, you have 15 tasks in your bucket which you need to complete. Okay, so let's take a quick example on this. So the task you have got 15 tasks to complete, and you have a certain amount with you. Let's say it is $1000, and you cannot increase this amount. So that is kind of a constant, because you have limited funds. So now the question would be, out of these 15 tasks, what you need to do is you need to set a priority for the tasks. So for example, one of the tasks in the list is joining the gym. The second task would be studies or tutoring. The third is rental cost. Fourth, let's say, is you're going for a trip. Let's say fifth is you need to buy a laptop. So and there are plenty more to do it, and everything has a cost in front of it. So what you need to do is, out of the 15 tasks or whatever the task you have, out of the 5 tasks, what you need to understand is, how do you prioritize it? What is the basis? What is the most urgent thing which you need to do? So probably this would be ranked as first. A rent is something which is again um, a kind of a important fixed cost, because then probably buying a laptop, if you're using it for studying, that could be done. Joining the gym and trip, probably this could be the sequence, and based upon this, you'll have to make sure that this amount gets allocated. So in this example, the constraint was the funds which we have, right? But then, apart from the funds, there could be a constraint on the capacity as well. So what if there's a capacity constraint? What if the machine cannot produce above a certain amount? So let's say a machine has a capacity of 90,000 units that it can produce, and your demand is 1,20,000 units. So you need to understand that which things you are going to prioritize. So let's say your capacity is this, your demand is this, and you produce two products, A and B. So you need to understand which product needs to be prioritized now, or is there a proportion which you can use, or a proportion which can help you to understand. So out of this 90,000, how many product A you need to produce, how many product B you need to produce. Is there a way to calculate it? So yes, there is a way to calculate that, and that is something which, as a CMA or a certified management accountant, you are expected to do on a regular basis. So and if you're joining specifically a manufacturing industry, then this is something which is really very important for you. So you might have heard that a, a name of as management consultant or a strategic consultant. So what basically a strategic consultant do is that he makes sure that using the theories of CMA or costing theories, he'll give you an opinion that, look boss, you need to produce product A this much, say for example 50,000 quantities, and product B 40,000 quantities. If you imbalance it, the net effect would be you cannot make an optimum profit. So that is something, as a management consultant, you will have to tell the the management. So the management will come to you and they'll tell you that, look, we have a problem. The problem is we have a lot of demand which has been confirmed by our sales team. They have been doing surveys, they have the stock, they have the details, and they have found out the demand is 1,20,000 units. But currently we can only produce 90,000 units, and we have got two products. These are our kind of master products. We can only use our factory to produce 90,000 units, because the moment we go on above 90,000, there's a chances that the machine would broke down. So now, as a management consultant, you have to go to the management and tell you, look, I have made my calculations. You can produce 50,000 units of A and 40,000 units of B. And then what is going to happen is this becomes your 90,000 as the total capacity. So your factory is working at an optimum capacity now. There is still a deficit of 30,000 units, which you, based on the current scenario, based on the current situation, you cannot meet the demand. But then there is always an option to go for a new factory, or a machine which can help you to generate the demand. So now this this would be a decision wherein you call it as a make or buy decision, wherein you make this 90,000. So this is your make, and now the question is, how do you meet the demand for this 30,000? So either what you do is you go to the market, you buy a factory land, you buy a new machinery, you buy a space, and you make sure that this demand is met. But then if you are going to go to the market, buying a new factory is expensive. There are costs involved. So the revenue from these 30,000 versus the cost which you have incurred, probably the fixed and the variable part, that needs to be compared initially. And then you can decide, look, are we in a position to meet this demand? Can we make this in a new factory? Okay, this is the costing of it. Or what you can do is you can call your friend and ask him, look, brother, we have a demand of 30,000. What we are going to do is we are going to outsource this now. So you are charging something from the customer at a certain rate. Let's say you're charging the customer at the rate of 10. So what should happen is, so 10 is your revenue, and the outsourcing that you're giving it to your friend or any other company to outsource it, the amount which you're paying to that should always be less than 10, because the difference would then be your profit. If somebody is quoting you a rate of, say, 12, that doesn't make sense for you to outsource this, because 10 versus 12 is something which is not a positive cash flow for you. So this is again something which needs to be understood and needs to be taken care by a CMA. So that is kind of your primary responsibility. So that's why production is equal to supply or demand. But then if it is not equal, you have to apply a theory of constants. And the fourth one was we are ignoring the time value of money. We are not concerned about time value because it is a core uh, financial concept. We are into costing now, so we are ignoring the time value of money. So then, once you are familiar with these assumptions, it is important for you to understand how the contribution statement works. So it start with sales, then you reduce the contribution margin, sorry, the variable cost, then you get your contribution margin, you reduce your fixed cost, and what you get is your profit. So this is kind of a very, very basic statement which we require to do all the analysis. Then there are multiple questions which management is going to ask you. So these questions are usually asked when a new project or a new decision needs to be made. So the questions basically are how much units would be required to be at no profit position. No profit, no loss position. That is the first question. That means the company is asking you that what is your break even point. That is something which is called as a break even point. How much units would be required to be at a no profit, no loss position? You started a project, so how many units you need to sell out to make sure that you're not at profit, you're not at loss, so you are at zero profit. This is called as BEP in units. Or there could be a situation wherein the management is going to ask you, look, you need to tell me how much sales in value would be required to be at no profit, no loss position. This is called as BEP in dollar or BEP in value. So how much is that point? How much is the break even point for it? So if you sell this much, you will be at a break even point. So how do you calculate that now? So let's understand. So if my sales are 1000, my variable cost is say 700, that becomes my contribution margin of 300. Let's say my fixed cost is 100 and my profit would be 200. This is something which can be calculated easily. So once you make this, just make sure that when you put in the figures, it is more appropriate for you to segregate this statement into two parts. So just make sure you segregate this statement into two parts. So let your fixed cost be at a different position and your sales minus contribution margin minus variable cost is equal to contribution margin. Just make sure that is been accounted separately. And what you do is instead of putting it in totality for your sales variable cost and contribution margin, what you do is it's better you put it as on a per unit basis. So that is something which is going to help you whenever you solve a CVP question. So what it means is that once you have the things, once you have the per unit cost, the whole formulas you can directly apply the things to. So it's 100 per unit. minus say 7.5 is my per unit cost. Then sorry, uh, so 10 is my sales price, 7.5 is my variable cost, and this becomes 2.5. This is my per unit cost. And what you want is you don't want the full statement. You only want sales, variable cost, contribution margin per unit, and a fixed cost in total. So once you have these four figures with you, you should be able to calculate multiple things out of it. So how many units do I need to be break even if I have got these equations with me? So for the BEP in units, this would be equal to fixed cost. So fixed cost is always total. That's why we have it in total everywhere. Then what you do is you divide it by the contribution per unit. So the fixed cost we have is this, that is 100. Then you divide it by contribution per unit, which is this. And then if you want to take an answer for it, it will be 100 divided by this. That means you need 40 units at the given rate. And if you can produce those 40 units, you would be at break even. If you want, we can cross verify this. So if you see, the as per the original statement, it was contribution margin total minus the fixed cost is going to give you the profit. So 2.50 is my contribution margin. You multiply it by the number of units you need to produce, that is 40. So this gives you 2.5 multiplied by 40 is 100. Then less your fixed cost, which is 100, and this becomes 0. This is your profit. What if you directly needed the value? What if you directly needed the value? You can still use it using the same formula, but this would be BEP in dollars is equal to fixed cost divided by contribution per unit. So instead of contribution per unit, you require the contribution margin ratio. So how do you calculate that ratio? Assuming that the sale is 100%, so this would be variable cost divided by the sales into 100. That is going to give your variable cost ratio. Sales minus variable cost ratio is going to give you contribution ratio. That is 25%. Can you calculate it separately? Yes, you can calculate it separately, which is 2.5. So this can also be done as 2.5 divided by 10 and multiplied by 100. That is also going to give us 25%. So when you want a contribution ratio, you need this 25% right here. That is 0.25, and the fixed cost was 100. So this becomes 400. That is your break even point in dollars. So if your sale value is 400, with the equations which we have, you should be able to break even. That means there is no profit, no loss to you. That could be verified from this point as well. If these are units, if this is 40 units, and then you can multiply it by the sale price, which is 10. So your answer comes to $400. So what my point is, there are multiple ways to calculate it. Some can directly use the contribution ratio and get an answer. Some might want to use the units initially and then multiply it by the sale price. You can do that way as well. Either way you can do it. So let's quickly move on to one of the examples right here. which says Ray company manufactures wireless routers and sells them to the distributor for 60 each. Ray company's variable cost is 35 per router. What was the unit contribution margin? So we know that the unit contribution margin is sales minus the variable cost, which is your contribution margin. It could be per unit and in totality as well. So here the sale price is 60 and the variable cost is 35. That gives you a contribution margin of 25. So that is 60 minus 35. Now it says if Ray company sells 10,000 wireless router, total revenue will be. So what they're doing is they're multiplying the sales with the selling price, which is 60. That gives them the price of $600,000. How do I calculate the total variable cost? It's again 35 per order into the number of units, 350,000. How do you calculate the total contribution margin? It could be 60 minus 35 is 25 multiplied by the units, or you can just calculate it in totality. Either way you do it, the answer would be still be the same. Then these are the formulas which we discussed. Contribution margin ratios expressed as a percentage of sale price, that is contribution unit contribution margin divided by unit selling price. So if you see, this ratio would always be the same, even if you calculate it at as a per unit basis, or you calculate it on totality using the total margin versus total revenue. The ratio, the percentage would always be the same. So let's check this out. So Ray company manufactures wireless routers and sells them at 60 each. That's the same question we have. The contribution margin is 25. So how do you calculate the contribution margin ratio now? So it's 25 divided by 60. That comes to 41%. If you don't want to calculate this, you don't have the information on this, but you still have the total figures with you, you can always calculate it that way using 250,000, that is your total contribution margin in value, divided by your total sales in value. Again, the ratio would be the same. So what exactly it means is that the contribution margin, that is the leftover, would be used to pay off your fixed cost first. This contribution margin will be first used to pay or to recover or to be set off against your fixed cost. And once your fixed costs are covered, whatever is left is your profit. This is a small contribution margin statement, but trust me guys, this is one of the most important statements which you're going to study in your all your analysis. It only has 5 elements, but then all these things are pretty important for you. So is sales in units and value, variable costs in units and value, gives you contribution margin, fixed cost, and operating income. There's a tip as well, which says the preceding formula can be used to check an answer on the exam. At the break-even point, number of units, the operating income will be 0. So what I used to do when I used to get this any of the questions, instead of remembering the formulas and all, what I used to do is I used to make the things simple for myself. If you want, you can always do that. So whenever there is a CVP problem coming in, just make sure you have your statement ready quickly. You can just put it like a rough work or something, like this, the one which we did. So this is something which you can just do it on a rough work or something. So always make sure you have 3 things you need. You need per unit, you need the units, and you need the dollar value. So let's just put it into examples. So the one which we had. This would be 2.5, the one we had. Unit, say let's say it was say 100 units. So 100 units would be constant again. So just make sure you kind of learn this kind of a statement. And fixed cost was 100 in our question, and the profit comes to this much. Specifically, this has been kept empty.
Sir,
Okay.
in units, 100 minus 100 is equal to 0.
No, 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 no. So units are my multiplier. So what is going to
Okay.
happen is units would be constant. So this is 10 multiplied by 100, that gives you 1000. Again, the variable cost is again applied on the same units, that gives you 750. Contribution margin is again applied to the same units, which is going to give 250. So you cannot make it zero right here. You cannot make it zero. That's why I'm saying that's why what the point is. In the examination, just make sure that you have this small statement ready with you whenever you want to solve an MCQ question. Just make sure you have this statement ready with you. You don't want per unit fixed cost, you don't want per unit profit as of now. You don't require that. The only thing which you require is this thing. So for example, if this is not given to you, let's say for example, if this is sort of not given to you and units are given to you as 100 somewhere in the question, how do you calculate the per unit now? How this 10 would have came? So it would have been 1000 divided by the units, right?
Divided by 10. Yes, sir.
The 100 units, right? Same thing would have happened for the 7.5. If my cost is 750 and I am producing, so if my cost is 750 and I'm producing 100 units, or I'm selling 100 units, what is the per unit cost? So it's 750 divided by 100, 7.5. If I'm earning 250, on how many units I'm earning? I'm still earning it on 100 units. So all of the three will have the same units, and that is something which you need to uh, remember, or you can just make a note of it somewhere. Or if you don't want to use this method, I'll tell you the other way as well. If you don't want, if you're getting confused that okay, units minus units, this says less, this should be zero. Don't worry, just write the unit somewhere else. You don't need this. You can just make sure that this is not there, and you can just write unit somewhere else. That's it. So that makes sense now. For you, just make sure this is per unit and this is in totality. So just remember that way. Either way you can do it, but this is going to help you to understand the things pretty quickly. Even if you're going to give an MCQ answer on it and you want to just quickly cross verify as to whether your answer is correct or not, so it is easy in CVP analysis to judge that, because everything has kind of a cross checking mechanism. So if I am telling you, for example, the break even units what you have calculated is say 75. Let's assume that you've calculated, you've done an answer for it, and the 75 is your break even answer. So your break even answer you're about to take is 75 units. Cool. You did a formula, you calculated something, and you got an answer of 75. What you do is you just put it here. So what it means, what does a break even point mean to you? Break even point means that the profit should always be equal to zero. That is, you are at no profit, no loss position. Or your fixed cost, sorry, your fixed cost is equal to your contribution. So it's not the case right here, right? So what is the definition of a BEP? So BEP means either your profits equal to zero, that is no profit no loss, and the second is your contribution margin dollar value is equal to your fixed cost dollar value. So now tell me, if if you have got a 75 answer with you, and if you're putting it here, so your fixed cost in value is not equal to your contribution margin, or your profit is not equal to zero, that means these BEP units which you have calculated are incorrect. That's how you can quickly check once you have the this table ready with you. So just make sure, what I used to do was, uh, in this mock test and all, whenever you have this CVP analysis coming in, what you do, once you get a question paper, just have an hypothetical example written in front of you. So for that example you're going to use throughout your CVP analysis, just replace that example with the actual figures and you will get the answer. Or if you don't want to do it that way, there would be a rough paper with you in your examination. Just draw this kind of a hypothetical example there, so that it is going to recollect a lot of things for you. So if I want to calculate the BEP point of this equation, this is my original equation. If I want to calculate my break even point, my BEP would be equal to my fixed cost, which is 100, then divided by my contribution margin, which is 2.5, and this is going to come to 100 divided by 2.5, 40 units. So according to my formula, the answer is coming to 40 units, which should satisfy these two conditions. So let's check this out. So what does a BEP point mean? That my profits are zero, that is correct, and my contribution margin should be equal to the fixed cost. So quickly I can just cross verify this answer immediately. Cool. This is kind of a eye-opening example, which says Carl company sells its product for 100 per unit. So this is your selling price now. So what I'll do, when I get these type of questions, I have my sort of a table ready. I don't know whether before reading the question, I am not aware that whether it is given in per unit or is it given in totality. So I'll just make everything zero. So it says sells its product for $100 per unit. So it's a selling price, and it says per unit. So this is 100. The fixed costs are $120,000, and the variable cost per unit is 60. So variable cost per unit is 60, and the fixed cost which they have told us is 1,20,000. The contribution margin is 40 per unit. Even if that is not given to you, you can calculate it. 100 minus 60 is 40. Which is the contribution? The contribution margin is 40 per unit, which is the contribution to the coverage of the fixed cost made by the sale of each unit. The following chart shows how the contribution margin increases as sales volume increases. More of the fixed costs are covered and operating income changes from negative to positive. So what they have done, they have given you a different scenario for 1000 units, 2000, 3000, 4000, and 5000. So let's take the first example. So the sales volume is 1000 and your selling rate is 100. So 1000 into 100, this is going to give you 1 lakh or 100,000, minus your fixed cost, contribution margin minus your fixed cost is going to give you an operating income of 80,000 units. So this is your negative 80,000, which is there now. So what it says is, the more your contribution margin increases, or the more number of units you increase, for every 1 unit increase, it is going to contribute to your fixed cost coverage. So what it means by that is that if the units produced are 2000, the profit has increased from 40,000. How it has increased? It was negative 80. They had 40,000. That's why it became negative 40,000. So 40,000 increase in the profit. So what it says is the following chart shows how the contribution margin increases as sales volume increases, more of the fixed costs are covered. So what do you mean by more of the fixed costs are covered? As soon as the whole fixed cost is covered, contribution margin should equal to your fixed cost. So what if I produced 1001 units? So as soon as I increased my sale units from 1000 to 1001 by 1 unit, how much was the contribution margin increased? So it was increased by 40. This minus the original one. So it was increased by the per unit thing. And this 40 was used to recover this fixed cost for 1 unit. That's why if you see the difference, the net difference came down to 40. Oh, sorry. So my profit got increased by 40. My profit got increased by 40 because as I made one extra unit. What if you produced 1002 units? It should increase, the difference should increase by 80. So what is happening is the moment I am producing more units, I am reaching what my aim is. My aim is to reach zero profit. That is the break even point. And at the break even point, what is going to happen? My fixed cost is going to be equal to my contribution margin. The moment I start increasing the units, say from 1110, so this would sorry. So now what has happened is once I have produced 110 units, it has again made sure that I have made a 4,400 more profit based on my original figure. That's what it says. For example, if you produce 2,000 units, so ultimately what happens is from your negative loss of 80,000, you come to negative loss of 40,000. So this 40 into 2,000 units, that is 80,000, are being used to recover your fixed cost. That's what has happened here again. But what happens is once you produce 3,000 units, your all the fixed cost is recovered. Your all the fixed cost is recovered, and this is called as your break-even point again. So that's what the example is basically telling you. So the moment you sell 1 unit above your break-even point, you start earning profit. So if I sell 3001 units, I would be making my first profit, and that first profit would be equal to my per unit contribution margin. So the moment I make 1 unit above my break-even point, my profit is always equal to my contribution margin. So what if I make 2 more units? What if I make 2 more units? For 1 unit, so it says for 1 unit, I get a profit of 40 above my break-even point. If I'm making 2 units, I'll get a profit of 80. This would be 3002, 3002, 80. So the logic is how many more units you need to make in order to get your desired profit. What if I tell you, look, what you're doing is basically on a trial and error. I don't want that. What if I tell you as a management, look, what you're doing is this is kind of a dependent variable, and what you're doing is you're changing the units. Bro, I don't want this. I don't want this. What I want is I'll give you the desired profit, what I want in my company. That's how the sales teams work. They're not going to do this trial and error every time. They'll tell you, look, you are a CMA, you should have the things in place, you have studied this. What if I want my net profit to come to $50,000? What if I want this profit? Now you tell me how many units I need to make. I don't understand what is break even. I don't know how the companies work. I don't know. Point is, I don't know how what is called break even. I don't know what is contribution equal to fixed cost. I'm not aware of profit equal to zero. I'm not aware of all these concepts. What I'm only aware of is you tell me a one answer which will make my profit equal to 50,000 based on your equation. So that is something which is called as calculation of targeted profit. It is called as calculation of target profit. And this is something which the management is going to tell you. Management is not bothered how do you calculate it. They just want a figure. So because you are aware that this figure, which is of contribution margin, is first used to set off your fixed cost, and then whatever is left is called your profit. That means if you want a target of 50,000, this is your profit. It is deemed that to become profitable, you will always have to recover your fixed cost first. So just recover your fixed cost, and then you want a profit. Because if you don't recover this 120,000, the fixed cost, you cannot be at the profit. So if you want a profit of 50,000 units, so we can just revise this statement and calculate it here. So if my desired profit is 50,000 units, see, my fixed cost is not going to change. Sorry, 50,000. Sorry, $50,000, not units. My fixed cost is not going to change. Then what I can do is I can calculate it in a reverse order and get my revised contribution margin. So if I want a profit of 50,000 units, my contribution margin should be 1,70,000. And based on this ratio, because the per unit will not change, it would always be constant. So what if I tell you I want $1,70,000 from you, and for every dollar the rate per unit rate is 40. You can easily calculate it, right? How many units do I require? So you'll tell me just produce 4250 units, you will be at a profit of 50,000. We can check that out as well. Let's say we produce 4250 units. 4250 units, and your profit is 50,000. But when you need to, once you have this question in place, if you want to remember the formula, I have the formula as well for your beneficiary. But then what I prefer is calculating it in a reverse order. So once you have this table with you, this is going to help you to calculate each and everything. So for me, I don't remember the formulas. I am not aware what the formulas are. I don't want to remember that. Same goes with your ratios and all. So where it is easy to remember the things, you can always do it. Where it is easy to interpret the things, just make sure you follow the interpretation process. If you want the formula, I can give you the formula. So calculation of target profit is equal to fixed cost plus the profit, and then you divide it by contribution margin per unit. That's what we did. The fixed cost. So if you see this, the fixed cost was 50. Sorry, the fixed cost was 1,20,000. The required profit was 50,000. Oh, I'm so sorry. The fixed cost was 1,20,000. The required profit was 50,000. So that we added it, and we went up to 170, and we divided it by the contribution margin per unit, which was 40. We got an answer of 4250. Somebody can also tell you that what is the value of that of those units. You can always do a multiplication into the sales value. So if these many units you need to sell, what would be the sale value? You can just multiply it by the selling price, which is 100. So this multiplied by 100, this is going to give the sale value, which you already have it right here. That's the value. So it is important for you to understand that every time this statement is going to be a survivor for you. Any questions you have on this? Okay. So because you have calculated the break even point and you have the things in place, the management can also ask you to calculate a safety level. So they told you that they wanted a profit of 4250. I mean, they wanted a profit of 50,000 units, and you gave them a figure that, look, produce 4250 units and you would be at a profit of $50,000. What if they tell you that what is the safety we are currently having for our product? So by safety, what it means is the moment that safety buffer is reduced, you will start incurring losses. So I'll tell you what is the safety level now. So these are the units which basically make me break even. What if I am producing 2,999 units? I should be making loss because that's not my break even point. I'm making a loss of 40. Okay. So how many units would I be required to maintain my safety level? That is called as margin of safety. So what does margin of safety means? It is your excess sales over your BEP sales. So it's excess sales. That is more sales above your BEP sales. The more you have, the better it is. So it's basically actual sales less your BEP sales. This would always be a dollar value. So what are my BEP sales? So if this was my BEP point, what are my BEP sales? So my BEP sales are 300,000. What are my actual sales? My actual sales is 4,25,000. So I'm just assuming that these are my actual sales. The actual sales figure would be given to you in the question every time. So it would be like the question would be stating it in this way, that you have an actual sales of 4,25,000. So what is margin of safety? So the question would be, if your actual sales are 4 to 5,000, then calculate MOS. So for calculating MOS, you need to know what it means. It means your actual sales and your break-even sales. You don't have your break-even sales, you will have to calculate your break-even sales by using. You can either use any of the formulas, or you can directly use this table to calculate it. And once you have that, this difference in sales is called your safety sales. That is a margin of safety. That is 1,25,000. That means I still have a sale value of 1,25,000 available with me before I can convert myself into a loss position. The more actual sales you get, the better it is for you. The safety level is increasing. So safety level is basically the buffer level. The buffer above your break-even sales. So more the buffer, better it is. What if my actual sales are 2,50,000 I don't have a safety level available with me, so this would be 0. So basically, you don't have a safety margin of safety once if you are working at a point which is below the break-even point. It is only applicable when it is you are above the break-even point. So there could be the questions in the exam wherein uh, there are two companies. One company wants to calculate the margin of safety before achieving the break-even point, and there is another company who has already achieved the break-even point and then have to calculate margin of safety. And if you would be required to comment on that. So your comment should be that the company who has not issued, not at the break-even point, they should concentrate first on getting to the break-even point, and then they can think of having MOS or margin of safety sales with them. So just take it step by step. First step is get to break-even, then move on to the margin of safety. So if we just divide this MOS, we also get a MOS ratio. So MOS ratio is equal to the margin of safety divided by actual sales. So my margin of safety was say 1,25,000. Then you divide by actual sales, which was 4,25,000. And if you do it a percentage, it comes to at about 29%. The more the percentage, the better it is for you. Cool. Okay. So now there is one kind of a quick thing which I want you to research and come back to me in the next class. Okay. In this question, the one which we did with wherein we had a profit figure given to us, which was 50,000, we calculated it by using the reverse methodology, right? Or you can just use the formula. So what I mean by that is when then there is a target profit, you can always use a formula which is fixed cost plus your target profit, and then you can divide this by your contribution margin per unit, and you can get an answer. This is contribution margin per unit, right? So we calculated this to be 50,000, the target profit. What if I tell you I don't want the target profit, I want the profit percentage? I have a target profit percentage in my mind, and I want you to tell me what would be my profit amount and the required sales for it. Okay, let me just define my question again. Instead of giving you the targeted profit, what if I tell you I'm not going to give you the, so this would be a dollar amount, this would be a dollar amount, and oh sorry, yeah, this would be the dollar amount. What if I tell you I have a target profit percentage in my mind? Then can you give me the revised statement? Can you calculate it? Can you give it a try? Take this as a homework, wherein you have got a target profit percentage with you, and you have to give me the value of sales which I need to make to achieve the targeted figure. So what you need to understand is the profit amount is treated as the variable cost, and the new contribution margin is calculated. So this is kind of an homework for you. So I'll tell you the hint on this. It says profit amount is treated as variable cost, and new contribution margin is to be calculated. So So what if I want a targeted profit of 15%? In the same example, in this example, the profit amount or the profit figure would be treated as as a variable cost, and a new contribution margin is to be calculated. So give it a try. Okay, just try to concentrate on these words. Profit amount is treated as variable cost. This is kind of a important line, and new contribution margin is calculated. If you want to, you can just give it a try. Just use the same table, add another column of percentage. So sales percentage versus the profit percentage versus the variable cost percentage versus the contribution percentage. And then there would be two variable cost. One would be the original, the one, and the other one would be the one which you require, the percentage. That would reduce your contribution margin, and that would increase your number of units. And that is something which we need. So this is something which you can take it as an assignment. Does anybody have a question on this? Take it as an assignment. If you haven't understood, you can just tell me. I'll re-explain it. But just give it a try. Go on Google, check it out. You have notes, go on your notes, check it out. The way we have targeted profit, I can also tell you to calculate a targeted percentage. What I need is the sale value ultimately. So if my sale value is X, then my percentage should be 15. So what is that X amount? And for that, what we need to do is profit amount or the percentage is treated as the variable cost, and new contribution margin is to be calculated. That's kind of an hint you have. So take this uh, as an assignment and just try to solve it. If you want to go on Google, check it out. Want to use any of the methods, check it out. Just try it. You should have an answer in place, because this is something which management usually is going to tell you. In practical life, they're more concerned about the percentage. So what I mean by that is, whenever there's an analysis which is required, all the figures are certainly converted into percentages and then being presented to the management. So it was important for you. So this is important. Calculating target profit based on the value is important. But then this is more practical. If I want a targeted percentage of 15, what is my sales value? So it's targeted percentage. Okay. And then for that, the profit amount or percentage is treated as variable cost. If you're treating it as variable cost, then give it a try. So moving on now with the one which we have. This is the diagram which we did discuss in the last class. It has its own significance. It's kind of a replication of this image or this question, wherein the revenues and the costs are plotted against the units, because the fixed cost is let me just take a snip of it. So, sorry guys. Not getting screenshot now. Uh, so I'm not sure why it is not getting from there. Yeah, sorry for that. So this chart is basically explaining you the fact that whatever happens, this proportion would always be maintained when it comes to CVP analysis. So because my units are irrelevant for calculating my fixed cost, the cost is basically constant. As my units increases, my variable cost is going to increase. That is something which is increasing constantly. So as the number of units are increasing, so if you see this, as the number of units are increasing, then my variable cost is also increasing. More the units, more the variable cost. And because my variable cost is increasing, my total cost is also increasing, because that is kind of a driving force for it. This one is basically again increasing. If I want to join the variable cost and the total cost, it is increasing. And it all depends, this whole scenario is all dependent upon how your revenue is increasing. So if your revenue is increasing, your cost is going to increase, but your fixed cost is going to remain constant. So once your revenue increases, the fixed cost is constant, but variable cost and total cost will increase in the same proportion. So this proportion would always be the same. That's why the lines are showing as parallel. That is something which that image is going to is basically telling you. Break even point, we've discussed that. Break even sales revenue, all good. Then there is something called as profit requirement, wherein we discuss that how much profit do we require. This is the answer for the question or an assignment, guys. uh, just make sure you just check it out once. I'll take this in the next class. Now the most important kind of a revision thing which we need to understand is how this activity costing is going to work when it comes to yes, this one. Yeah, so what happens when there are more than one product? So the basic assumption what we are doing here is we're assuming that there is only a single product, and we're calculating it, but it is not usually the case in practical life. In a practical life, there are multiple products, and for that multiple products you should have a multiple break even points. So we have a question here which says, so if you see this, it says break even analysis is related, easy to do for the company that sells only one product. It's easy to do that. However, most companies sell multiple products. According to the break even analysis of a company that sells two or more products is a more complex kind of a category, because you have multiple products and then there would be multiple sales. To use CVP analysis, when more than one product is sold, we have to assume one thing: the sales mix is constant. So what do you mean by sales mix? So if a company is producing certain products, say for example the company is producing product A, B and C, the ratio, that is, if this is 2, this is 4, I'll just make it 3, and this is 1. So this ratio, that is 2 is to 3 is to 1, the sales mix ratio would be constant. So until that ratio is constant, you can use the break even point concept. Once the ratio changes, you will again have to calculate the break even. So this is one of the favorite questions of the examiner, which is being asked in your essay type questions. So what if you have a question on CVP analysis in your examination? It would initially tell you to calculate a simple break even point. So the question would be like some would be framed like this: that there is a company which started in 1985 with a single product, say it say cakes, and then all the information would be given to you until, say for example, until 10 years of time. So it would be like a company which was established in 1985 was selling a product called cake. It was selling this from past 10 years now with all the variable cost and fixed cost information given to you. Then the management has now decided, after analyzing the demand, that it requires to add on the products. So the company is now willing to add, say, pastries uh, and cookies into their product list. And then again, the information would be given to you for cookies and pastries. And then it will tell you, calculate the break even point in both the scenarios. Okay, so the first scenario is where there is a single product, which is the cake. You calculate a break even point. And the second scenario is wherein you have three products, and the ratio would be given to you, that 3 is to, or 2 is to 3 is to 1 is the ratio as to cake is to cookies is to pastries. And then what they'll do to add a twist into it, after that, after this whole question is done, they'll tell you that what if the company wants to change the ratio to 5 is to 3 is to 2. If this is the ratio they want to maintain, then what would be the break even point? So there you need to calculate three break even points now. One for the single product and two for the different mix which would be there in the question. So so when there are like multiple products which are given to you, the decision maker, the most important element in the statement, is your contribution margin per unit. Without the contribution margin per unit, you cannot calculate this sales mix break even point. So let's just look at this example. So total sales in the units of the company consists of 40 of product A and 60 of product B. So the ratio is 4 is to 6, or you can call it 2 is to 3, whatever you want to calculate it, or how do you want to interpret it, that is a different story. But that is 40 is to 60. The selling prices are 4 for A and 3 for B. Variable costs are 2.5, 1.75 for A and B. And the fixed cost of the company are 75,000. Because company is paying the fixed cost, it is for the whole company and not for a single product. Determine how many of each product needs to be sold to be at break even. So what you will have to do is, you have this table with you in place. So because you're working on this table, you will have to make sure that this is for table, this is for A product, and then you have to calculate the same thing for product B as well. And then what you will have to do is, you will have to make sure that you calculate it in total as well. So total as in, you only need the value in total, don't require uh, all these things, just the value you require in total. So selling price per unit is 4. So let me just put it as 4. And for the fixed cost, you don't want the fixed cost to be calculated for everything because it is a common cost. Fixed cost is a common cost. You only want it in total. And this total would always be your value. So that's how the equations are going to work for you. Okay, you don't want the individual breakup here. That is not required for you. If you have a different specific fixed cost given to it, you can calculate it that way. But then the fixed cost would always be done in totality. That's what it says. So the selling price per unit is 4 and 3. So I'll put it 4. I'll put it at 3, my selling price. Variable cost is 2.5 and 1.75. This should be 1, I guess, right here. There is 1 missing from here. So this was 2.5 and 1.75. So this is 1, guys. There is I guess a printing error here. Then what you need to do is, because see, you don't want units are basically irrelevant for you in this question as of now. But the point is, the fixed cost which is given to you in the question was 75,000. So this 75,000 is not distributable in product A and B. Don't distribute the fixed cost based on the ratio. It is not logical. Fixed cost is something which is for the whole company, unless a specific ratio for it is given to you in the question. Usually it won't be there. So once you have the contribution margin, so you have the contribution margin for A, you have the contribution margin for B. Okay, then what you want is the weighted contribution margin. So A was 40% and B was 60%. So if you see this calculation, calculate the weighted average contribution margin per unit based on the percentage of each items in the product mix as a whole. So what is the weighted contribution margin? Just give me a moment, please. Okay, so weighted contribution margin would be 1.5 multiplied by the ratio, which is 40%. And right here as well, it would be 1.25 multiplied by 60%. That's the ratio. So if you multiply it 1.5 into 40%, that gives you 0.6 and this gives 0.75. So this is their weighted contribution margin. Weighted contribution margin. And the total of it, of it is 1.35. So that is something which you need when there are multiple products. The formula for the break-even point still remains the same, which says break-even point in units is equal to your fixed cost divided by contribution margin per unit. But instead of using the individual contribution margin, you're going to use the weighted contribution margin now. So this would be fixed cost, which is 75,000, divided by the weighted contribution margin of 1.35, and your answer would be 75,000 divided by 1.35 is 55,556. So these are units. Cool. So these are units in total. Now what you will have to do is you will have to divide these units into A and B, based on the proportion you have. So this into 40% and the same thing value into 60%. So what if so you had a definition in place right here. Uh, what is the definition of break even point? Is that at break even point, the profit is equal to zero and the contribution margin is equal to the fixed cost. And you are saying that for A, you need to produce these many units. For B, you need to produce these many units. So you can check it out. So if you have the same ratio available with you and your fixed cost is 75,000 and you're producing two products, that is A and B, in the ratio of 40 is to 60, you'll have to make sure that you produce 2,222 for A, 3,333 for B. Based on their own ratios, you can have their total sales, total variable cost, total contribution margin that should be equal to fixed cost. That is going to give you the BEP point. So this is the break even point for this question. And that's what has been like given to you. So there are like multiple ways to calculate it. I mean, if you want to calculate it in value, you can calculate it. If you want to calculate it in number of units as well, you can still calculate it. Either way, you can do it. If there are 3 units, the things basically still remain the same. The only thing is that your calculation increases. Oh, sorry. The logic still remains the same. There would be some kind of a difference because I'm using Excel. The figures have made it easy for me. But if you're doing it practically, $1 or $2 difference could be there. So, any questions, guys, on this? Any other questions apart from this? So we haven't taken a break actually. So what I'm planning is a 10-minute break would basically make it probably 11:15 at my place. And what's the time in India? Right? Yeah. So the 10 minutes break would make it 12:45, 12:50 around that point. And I guess we are done with the time, to be very fair. Any questions anyone has? Any other things apart from this? Any other separate questions? I'm happy to there. I'm happy to share those.
No, sir.
No. Any how is your studies going and all? Like all good?
Yes, sir. It's going good.
Okay. So any other concept which you want me to like go through in your pre-CMA, wherein you want, okay, this concept needs to be brushed up a bit more. I can take a note of that as well. So just wanted to confirm if you have received the formula sheet from Uplift Pro.
No, sir.
No. Okay, let me just check it if I have it. Uh, mm, I guess you should be receiving it because you already have done ratios, right?
Yes, sir.
So when are you planning to give your CMA exams? Uh, like, do you have a plan in mind?
Yes, sir, in October.
In October. So this would be group two. I mean the part two.
Yes, sir, part two.
And what about others? Like, Hemant. Ha- So Pooja, are you comfortable having like having the questions and all?
Sir, right now I don't have question.
No, no, no. As in the, have you tried solving multiple questions? Because
Question bank. To
yeah,
question
question.
bank, sir.
Yeah, question bank.
Yes, sir, I'm doing question bank. But, right now I don't have any queries.
Okay. So how is your regular class going on? The one which you do.
It's going good, sir.
Okay. Okay. So what I'll do, I'll just tell Uplift to. Actually, I'm not able to find that list in my mails and all. So I'll tell Uplift to share that list, formula list with you, so that you have the things in place. Okay. So if you don't have any questions, we'll wrap up the class because we haven't taken a break. So 10 minutes break, that makes probably 2 hours for the day. Oh, there's a Himanshu is giving in Feb. Okay, cool. Okay, if you don't have any questions, I'm done with the class. Thank you guys for your time.
Thank you. Thank you, sir.
Divya, do you have any questions or? Divya, are you still there? Or you want? Do you have any issues? Otherwise, I would be closing this meeting off.
No, sir. No, sir. I don't have, sir. Thank you. Thank you so
All right,
much.
no worries.